So, notes receivable. A note receivable is a legal document. It's often called a promissory note. It's a legal document that is a right to collect money from another party. And a note receivable will typically show either interest and the date in which it's due, or an interest rate and a time period, and so one can determine the amount of interest associated with it. Why would you use a note receivable versus accounts receivable if you're having sales? Well, if it's a high ticket item, you may want to have the right to be able to collect back on that item, or take that item back and resell the item if the customer defaults or doesn't pay you. With an account receivable, you typically don't have this right, and so you can't take the item back and try to resell it. What you can do is you can damage their credit history with accounts receivable or reporting it to credit bureaus, but you don't have the right to take back the item. So, for example, an automobile. If you were to sell an automobile to an individual, you might not handle it as an account receivable. You would handle it as a note receivable, which means if the customer does not pay you, you're going to be able to go in and you are going to take back the automobile, which you can then sell. The other thing is when you're selling this item to them and it has a high dollar value amount, if you have a note receivable, then you can set up a schedule so that they will pay you over a longer time period than a typical account receivable. An accounts receivable would be maybe 30 days. With a note receivable, an example being an automobile, you could have that for 3 years. Now, if it's going to be a long period of time, of course, you would like to receive interest as well. So the note receivable typically has interest on it, and this starts from the day they are created until the day in which they're due, which is what we call the maturity date. Calculating the interest is very simple. You are going to take the principal, which is the amount that has been borrowed, or if it were in the case of an automobile, what is the dollar value of this automobile? You're going to apply an interest rate, which is usually in accounting, it is always annual. So I want you to just think of this as always annual, because in accounting that's typically what we use. And then a time period. For our calculations in this class, we're not going to count up days. We're not going to do daily calculations. Large corporations do use day calculations, and they have certificates of deposits and the millions of dollars, and it matters whether it's calculated on a day versus a monthly basis. In this class, let's use months. So the interest rate R is for an annual time period, or 12 months, and the time is a fraction of 12, and that's the way we're going to calculate it. So, for example, if we have $100,000, 6%, and it will mature in 2 years, that means that this note runs for 2 years, and at the end of 2 years, the customer should be paying back the $100,000. The interest rate will go through the time period for the whole year, and so 6% will be earned in each time period, each year. So January through December of the first year, it will be $6,000 in interest. This is calculated by $100,000 times 6% and 12 of 12 months, so for the full year. Now, this $6,000 is for 1 year of interest. The next year, it would be the same, $100,000 times 6%, and for the whole year, 12 over 12, or $6,000. So the total amount of interest this customer will be paying us is $12,000 because it runs for 2 years. On the second one, They take out a note, they buy something from us, take out a note, and it's for 10 months. Well, the interest is not going to be 6% for that particular one because it only goes 10 months. So 10 over 12 is the amount of interest which we would charge them, or they would pay us $5,000 in interest. Now, of course, they're going to pay us back the $100,000 at the end of October, which is their 10-month time period. But they're also going to pay us, so they're going to pay us the $5,000 in interest, and they're going to pay us the $100,000 in principal at the end of the time period, October 31st. This next one is only for 2 months. Only for 2 months. It seems a little strange. That's a lot of money to not have it over a longer time period, but it's for 2 months. If it's for 2 months, it's 2/12, 6% times 100,000, or $1,000. So there's a number of events that are happening then with the note receivable and with the interest. And we have to use a timeline. It's very helpful if you make out a timeline with these problems so that you understand what's happening. If we have a customer and we have sold them merchandise, and they may not have to pay that interest until the year is up, and the year may be up on October 31st, and our financial statements, though, are created and prepared year-end December 31st. This is 2015. The customer is not going to pay us the interest or the principal until October 31st. We need to think about this because under the accrual method of accounting, we have to record interest revenue as it's earned. We have earned 2 months of interest at this point, and we need to show it as revenue. So on December 31st, from this particular customer, we should show 2 months of interest. Now, we will show on October 31st, up to that point, the total of 10 months of interest for this next fiscal period. So this is our fiscal year end December 31st. We should have 2 months in there. Again, they took out the note here on November 1st, so between November 1st, December 31st, we have 2 months. We need to show 2 months of revenue here, and then in our next fiscal period, or our next fiscal year, which begins January 1st, 2016, ends somewhere out here, December 31st, 2016, we need to show these 10 months. So on November 1st, we have VHC lending, which is our company, lending $100,000 to a company, and it's going to be at 6% and $100,000 principal. Now, this transaction, what we're doing is we are giving them cash. I would think it's easier if instead of we think about them giving them cash, is we record a sale. If we were recording a sale, it would be a note receivable and it would be a sale credit. In this particular case, we are loaning someone money. And so we are giving up $100,000. We're giving it to them and they're assigning a note. And so we have a note receivable recorded. This is an asset, this is an asset, and it's an asset swap. It shows up here when we analyze this transaction. Well, at the end of the month, we need to show that we have 2 months of revenue off of that particular note. So 100,000 times 6%, remember 6% is the annual rate, times 2/12 gets us $1,000. So we need to record $1,000 of revenue for that year for this particular note. Now, we don't get cash at that point. They're not going to pay us cash because we are not due this interest in cash until in the next time period when they pay off the note. But what we will do is, to make things work, we will show it as an interest receivable. Now the goal in what we're doing with this journal entry is to record the proper amount of revenue according to the accrual method. So accrual accounting, financial statement, we have earned it. It's proper for us to record revenue when we've earned it. So we need to record revenue, and we need to have a debit. We need to put it in something to balance this journal entry, and we record it as an interest receivable. Now when, at the end of the time period, we are actually paid, the total amount of cash interest we will be receiving is $6,000. It's 6% of $100,000, and it went for a whole month. For a whole year, it was 2 months in our first fiscal period, and it's 10 months in the next fiscal period. But the total amount of cash which we are going to receive is $6,000. This $6,000, though, when we talk about revenue, recall we have recorded 1,000 of it related to the first fiscal period, so we need 5,000 in revenue recorded in the next one. So when we record this journal entry, it seems at first a little confusing, but if you keep track of several things going on, it really isn't. First, think about how much cash we will receive when this note matures. It's $6,000. So we know the debit has to be for $6,000. Second, think about the time periods in the timeline. How much revenue have we already recorded? 1,000. How much in total do we need to have? 6,000. Therefore, we need to record an additional interest revenue of 5,000. Now this interest receivable in this journal entry of 1,000 here that's being credited, we are crediting the thing we debited at the end of the fiscal year when we first recorded that $1,000 in interest revenue. So we are removing the balance in the interest receivable. It's proper for us to do this because the customer no longer owes us. The customer does not owe us anything because we have already, they're paying off the total amount, which is the $6,000. So they're paying the $6,000 now, which amounts to the $1,000 which we already recorded as interest revenue in the previous fiscal period. This fiscal period, this fiscal year, we need to record the $5,000, and this journal entry gets us there. This is one of the beautiful things about the dual entry accounting system, is that when we do this, you notice the balances are right. Our interest receivable related to this note will have a zero balance. We put in 1,000, we're taking out the 1,000 here. Our interest revenue in this time period is recorded properly. It is 5,000. We said 5,000 should be in this fiscal year, and the amount of cash we received reflects the actual cash which we brought into our company. Now, along with them paying this 6,000 in interest, they're also going to pay off the note. And sometimes you see that transaction which we had previously recorded with this transaction in one big journal entry, because probably what's going to happen is this customer is going to either transfer funds from a bank account to our bank account through some sort of a wire transfer, or they're going to write a check or a cashier's check for the amount. And the amount is not going to be 100,000. It's going to be 100,000 plus the interest, or 106,000. So oftentimes you see these two journal entries combined. In this class we're going to do it as two separate journal entries, and this is a journal entry which records them paying off their note receivable. So we originally recorded a note receivable and we gave them cash. Now they're giving us cash and we're removing an account receivable, a note receivable. So this is the opposite of the first transaction. You can think of it that way. It's a reversal of our previous transaction.